Hey, this is Lacey, your Las Vegas gal. I'm here with my friend Amber Coleman from Guild Mortgage.
Hello.
Thank you for joining me. We're here to help educate you about some of the terminology and the lingo that is out in the universe when you're buying a house. So inevitably there are acronyms and terms and long words that I don't even know what they mean half the time that come your way in the process of getting qualified for and also putting an offer on a house and then buying a home. So I asked Amber to join me so that she could help to educate you and me a little bit sometimes on some of the things that and what they really mean and kind of just break it down in layman's terms so that you're not frightened by it and you know going in what to expect. So today we're going to talk about PMI. Talk to me about PMI, because that's a term that's thrown around way too much.
It is, and sometimes people think PMI is a little bit scary too.
I am one of those people, so make me not scared of PMI.
Okay,
Tell me
it's not a scary thing because before PMI, PMI is principal mortgage insurance.
Okay.
Before PMI came out, people would always have to put down 20%.
Got it.
House.
Okay.
So PMI allows you to put down less money.
Okay.
It's scary because it allows money and it seems like it's not going towards anything.
Right.
But it's actually making it to where you can come in with a less down payment.
So when you so mortgage insurance essentially is required if you're not able to come in with the 20% down. On every loan, they're always going to require PMI if you're under the loan.
But there's
down.
there's ways that you can structure that. So like there's different types of loans too. So if you're doing a government loan, like an FHA loan, the mortgage insurance is set. It's a certain amount. It's the same amount for every loan.
That's good. Otherwise, it could fluctuate in other.
It does fluctuate. So that one's set at a certain amount. So it's going to be the same amount in any loan that you do.
Okay.
That one also, if it's an FHA loan, the mortgage insurance stays on for the life of the loan.
So if you get a 30-year balance, that additional however much hundreds of dollars on top of your payment that you're paying every month because you didn't have the initial money 20% down up front, that's on it forever unless you refinance.
Okay. So on those ones, you always want to look towards refinancing in the future to get the mortgage
when the
insurance
value's elevated.
As long as the rates are lower at the time.
Values need to be elevated and your rates need to be lower in order to make that work.
Yeah.
So, okay.
And then on a conventional loan, the mortgage insurance will vary depending on what your credit scores are, what your down payment is. It varies on a lot of different things. Honestly, it varies off if it's a primary residence, if it's a second home.
And that's where your team really comes into play because you can say, hey, we'll go help shop around the insurance rates, but at the end of the day, like, it's going to be based on these things, and then you can help them understand that at that point.
But you said an important thing, though, shopping around. Yeah. So mortgage insurance is just like any other insurance. There's multiple different companies out there.
Which is a good thing.
Yeah, so what we'll do is we'll shop it around to the different companies to see who
you'll run it through Geico, even though it's not
amount.
Geico, but you'll go to the Geico.
But to different mortgage insurance companies. So we always shop it. And there's different ways that you can structure it, too. So you can either pay it monthly to where it's included in your loan on a monthly basis, so there's a separate amount that you're paying that goes towards your payment. That will drop off once you hit automatically. If you hit 22% equity, once you hit 20% equity, then you have to ask for it to be removed.
And so that's where watching the market and staying in tune with the market makes so much sense. Especially if you live in Las Vegas, the house values, are very volatile. They're really high or sometimes they're really low. We're hoping that it'll level off at some point. But the good news is if you're watching the market and staying in tune, you'll see when the value of your home goes up, if you click over to that 22% you say, and you're at that 22% where you're above that, you can ask for that to be pulled off of
be removed.
So you're saving money on a monthly basis. So staying in tune with the market is really important.
Yeah, for sure. And then when you're doing a loan too, if it puts your payment too high to do it on a monthly basis like that, where you can ask for it to be removed, I can actually put it to where you're financing the full amount of the mortgage insurance into 30 years.
That's cool. So instead of it being $1,600 a month, it could be $1,450 or something because you've rolled it into the actual finance part of the loan.
Yeah. So it could drop your monthly payment. You're just having to look at it over the 30 years.
Got it. And then when you refinance, it goes away anyway. Same sort of thing. Okay.
And there's another way too. You can actually split it up. Hopefully, I'm not confusing with all these different.
I'm following you.
All these different ways of doing it. I'm just trying to let it be known. There's a lot of options to mortgage insurance. So just ask about it.
And don't be afraid of PMI. Genuinely, because
it's not. It's a good thing. It's allowing us to be able to put down less money and leverage our money.
Yeah. I like that.
by having PMI.
And it protects you, right? It protects the banks, it protects the process, and it gives you a chance, to your point, to keep a little money in your pocket while you're getting into that new home.
Exactly.
So, cool.
There is another option too, though. There is a mortgage insurance option where you can actually add protection if you lose your job.
Oh, nice.
Then it would pay your mortgage payment up to 9. I think it's 9 payments.
Nice.
So if you get laid off or something like that happens with your job, they do have that type of protection. You just have to pick the correct policy.
One more reason to not be afraid of it.
Yeah, don't be afraid of it.
So really the key takeaway for me is, obviously be aware of what PMI is. Be aware if you're not coming in with 20% down, that will be a component of your loan. It just has to be. And then really talk to your home, hopefully it's Amber, but talk to your home loan person and really get some information on what are your options. Can you finance it in? Can you look at breaking it up over time? What can you do? And then the addition of that job protection is something that you should definitely look into.
Yeah.
Cool. Thanks, Amber.
Thank you.
I hope learning about PMI didn't confuse you. I'm not going to lie. I always get confused when it comes to this stuff, which is why I'm a real estate professional and not a loan professional. But I'm here if you have any questions. I am not a loan professional or an expert, but Amber is. So if you have any questions, just click the link down below and let us know if you're interested in either qualifying for a loan, possibly looking at buying a house in 5 years, 10 years, 2 years, 1 month. Doesn't matter. We're here to help you. We want you guys to be ready and prepared the whole way through. Otherwise, be sure to like and subscribe this video. Thank you so much for watching. Thanks, Amber, for coming.
Thank you for having me.
Okay.
Okay, PMI. This isn't just regular insurance.
Oh, we don't talk about that. Okay. Is that it? Should we talk about how we're best friends?
Yeah, let's do it.
Talk about I'm not kidding. Let's do it.
Because you put it on there, you got to do it, right?
Yeah. Hey, this is Lacey, your Las Vegas gal. I'm here with my bestie.
We are true besties.
Amber Coleman from Guild Mortgage. And this is actually just a silly video to show that real estate professionals and loan professionals know how to have a good time. We were here videoing some stuff, filming some stuff. We're not videoing, we're filming stuff for YouTube for you to help educate you about the loan process. And in the process of filming, Amber wrote down on the ideas, we are best friends. And where that came from is that I was talking about how when you're getting a home loan, you really do want to kind of become best friends with your loan professional. You have to almost confess all your sins when it comes to your credit and make sure that they know what's going on. And for somehow that turned into now we are best friends, apparently, which we kind of are.
But it's important
It's totally
that we're
important.
best friends, though, because we're always on your behalf, looking out for you, and then collaborating on ideas to make things work.
It's really important. So a lot of people don't understand that, like, you can choose anyone you want to when it comes to qualifying for a loan. Like, in fact, you have to know that it's your choice of who you choose. That's very, very important. So if someone's recommended to you, you don't have to go through that person. But a lot of people assume if I'm recommending you that I'm getting like some kickback or a payment or a percentage. It's illegal. Yeah. I'm not allowed to get paid or a kickback or any kind of referral fee from Amber. I genuinely recommend her because I've used her for my own home loans. My family has used them for their home loans. And the reality is she's the best in the business. There's a reason.
Oh, thank you.
You're kind of
we're besties.
Yay. But truly, I genuinely feel that way. I want my clients to be taken care of the way I would want to be taken care of. And you and I have just developed such a strong relationship and bond over the last few years that has really helped us kind of know how to dance, you know, like if we have an issue that comes up with a client, all I have to do is make a call or do a text and we both go jump into action.
We'll figure it out.
So when you come already pre-qualified, that's always an amazing thing, but it doesn't necessarily mean that ease of it makes it a little bit harder for the process if something comes up because there's not a built-in relationship there that makes it easy to do business. So some things might be delayed a little or there may be hiccups and maybe not as flexible as a team like we've set up where you've got the realtor and the real estate professional and then the loan professional who agree to do business together because we know that we're going to take care of each other and we're going to always look out for our clients first. So,
and I think trust level is important on all levels. So to know that we have trust in each other and that we're going to reach out and do everything we can for our clients too.
So I guess we really did make a video about the fact that we're best friends.
That was a good note right there.
We are best friends. Like we actually got a good giggle out of it, but we were able to make something out of it. So thanks for watching. This is a very silly video that doesn't have anything to do with anything other than the fact that it really is important to work with people who you trust, and it's also important to work with the people that you trust. Does that make sense?
It makes perfect
sense to me. If you're interested in buying a house or looking at the Las Vegas market and you want to chat with me, please feel free to click the link below. I'll be in contact with you. Just fill out that form. If you're interested in pre-qualifying for a loan or you just want to talk about your credit and see if there's a way to get the scores up so you can maybe buy in the future, Amber's your gal. Again, click that link below, fill out the form, we'll get the information over to her and we'll get right back to you. Otherwise, like and subscribe this video, and thank you so much for watching.
Thank you.
Thanks for joining me, besties.
That's what we are.
All right, I'm gonna stop that.